Good morning, everyone. Welcome to our DAT weekly market update. This is our update for November 1st, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Dean Croak, who's our Principal Industry Analyst. Good morning, Dean.
Hey, Ken. Good morning. Good to be with you.
It's great to be with you. It's Ohio finally decided to go all Ohio on us, and it's dreary and gray and just kind of generally crappy today.
Yeah, we've got the same going on here in New England. We've got a house renovation underway, and we've had to move our brand new kitchen out onto the deck and cover it in tarps. And of course, it's rained this morning, so all sorts of fun.
Yeah. And on a non-weather related note, the Buckeyes pulled out a win there in Happy Valley in Penn State. Pretty thrilled about that. It's a pretty good weekend. I had a little bit more anxiety and high blood pressure than normal, but they decided after about 50 minutes they wanted to win, so they did.
Good for you.
All right, so let's get into our key points of the week because we have a lot to cover this week. So dry van spot rates are tracking very closely to 17 and 18 levels. We have an interesting chart, a couple of charts we're going to share at the end of the show for the question of the week to talk about that. Florida produce volumes likely impacted by Hurricane Ian, down about 90%. Diesel continues to be one of, if not the top stories in the entire industry. We're seeing record demand, but some pretty striking inventory levels and, or unfortunately, if you pardon the bad pun, paying the price for it in terms of diesel costs. Some rumblings about rail strikes starting to gain some traction. And as it was a surprise to me this morning, daylight savings is rolling off here this weekend, which means we'll fall back. And then a very mindful note from Dean about driver safety leading into that event. I know anyone with small kids can very much relate to the impact daylight savings time has. So with that, I'm going to turn it over to Dean to walk us through our market update. Dean?
Yeah, thanks, Ken. Yeah, daylight savings are a pretty big deal for a lot of people next week. Driving tide's a pretty big issue for carriers. Just keep an eye on pedestrians on Monday morning in the dark. A lot of people will be commuting to work on Monday morning when it's not usually as dark as it is. So keep an eye out for pedestrians. They're the ones that seem to get hit and injured the most during this transition in fall. So let's have a look at our load to truck ratios in dry van. End of month last week, shippers tend to clear their docks of as much freight as they can. Volumes are only up 3%. Currently, load post volumes are about half what they were this time last year and about 1% lower than 2017 levels. In terms of carriers posting their equipment for loads, they're about 20% higher year over year, up about 3% last week. That meant the load to truck ratio up slightly to 2.62, not a big movement, but very close to 2018, 2019 levels, as you can see there. In the refrigerated category, load posts were flat last week. And almost identical to 2018 levels when you break down the load to truck ratio into its components. Load posts in the reefer sector are about 60% lower than this time last year, down about 20% in the last month. Capacity continues to loosen. Equipment posts decreased by 6% in the last month. And in the refrigerated sector, now at the highest levels in the previous 6 years for the start of November, lots of capacity in the reefer market. Load to truck ratio up 6% to 4.21. And in flatbed, load posts are about 70% lower than this time last year. That sector continues to cool heading into winter. Again, that's not unusual, but volumes are way down when you compare to last year's heady numbers. Volumes decreased about 4% last week. Equipment posts are still at their highest level during the last 6 years for the start of November. As a result, the load to truck ratio moved up slightly to 11.41. Almost you could call that flat week over week. Having a look at our markets around the country, this week we're having a look at the Canadian spot market from our sister company LoadLink. The spot market fell slightly in September, dropping about 7% from August, about 20% down year over year. According to LoadLink, the slight dip in freight activity is still in line with regular season activity for US carriers and Canadian carriers crossing the border. Loads from Canada entering the US increased 7% last month, but are still down 27% year over year. In September, loads from the US heading north into Canada were down 22% month over month and 12% year over year. So a significant imbalance occurring there on the northbound lane. Lower spot spot market volumes in Canada were also reflected in some of the lanes. One of the lanes we've been watching for the last 18 months was Auto Alley from Laredo to Toronto. Of course, it was incredibly affected by the cross-border protests. In February, that was, spot rates on this lane spiked at $3 a mile in April this year, but have now returned to more normal levels at $1.27 per mile. That's about 57% lower since April. It's also about 10 cents a mile lower than this time last year. Having a look at the Pacific Northwest, load post volumes were up 11% last week. In the combined Seattle and Portland markets, outbound rates were up only a penny per mile to an average of $1.28. A lot of activity in the mid-Atlantic retail-heavy West Virginia markets last week. Capacity tightened for the fourth week in a row. Rates up 5 cents a mile to $2.13. Loads from Huntington to Hartford paying $2.42. That's up about 6 cents a mile over the September average. And unusually, capacity was very tight in the Northeast last week. Rates jumped 9 cents a mile to an outbound average of $2.18. That's in Augusta and the adjacent market here in Vermont. Having a look at the refrigerated category, this week we're talking turkeys. We're only a few weeks out from Thanksgiving. Fresh turkeys start to move about 3 weeks out from the actual day itself. Outbound rates in the top 5 fresh turkey producing states, Minnesota, North Carolina, Arkansas, Indiana, and Missouri, up 2% last week to an average of $2.50. That's just over $1 a mile lower than this time last year, though. The biggest turkey producing state is Minnesota. Rates are up 3% last week to an average of $2.56. Some of the longer haul lanes, Minneapolis to Ontario, California, paying $2.06. It's around 20 cents a mile higher than this time last month, but lower by the same amount compared to this time last year. Los Angeles from Minneapolis, $2.01, following similar trends to Ontario. Minneapolis to Dallas, another busy lane with fresh turkeys, have been increasing steadily since June, averaging $2.67 last week. That's about 52 cents a mile higher over the same time frame, but almost $1 a mile lower than the previous year. And just sort of broadening out to the meat patch in general, which is sort of those markets in Kansas, Nebraska, and Oklahoma. Reefer loads out of the meat patch were paying $2.74 per mile last week, up 4%, and up about 10 cents a mile compared to this time last year. Having a look at the flatbed market, capacity was pretty tight in Texas last week. Again, it's a big flatbed market generally. Outbound rates in the state were paying $2.28 as a state average, excluding fuel. That's around 25 cents a mile lower than the state average for the previous year, so this time last year. But it's also the second highest in the last 7 years at the start of November. The previous high was 2021 at $2.53 a mile. So pretty decent rates coming out of there for flatbed carriers. In Houston, it's our largest flatbed market. Load posts were up 1% last week. Capacity remained flat at $2.40 a mile for all outbound loads. One of the busy lanes we watch out of Houston is the 600-mile haul from Houston to Lubbock in the Permian Basin. That's the oil field. Rates have been steadily decreasing since July on that lane. They averaged $2.86 a mile last week. And on the incredibly busy flatbed lane between Houston and Fort Worth, loads moved were down about 13% last week. Spot rates averaged $2.86. That's about 50 cents a mile lower than this time last month. And in San Antonio, Texas, spot rates spiked by about 20 cents a mile. Capacity's been tight there for a few weeks. Average rates were around $2.61 out of San Antonio. Regional loads from San Antonio to El Paso averaged $2.13 a mile last week. That's up 18 cents a mile compared to this time last month and last year. So wrapping up our market update with a look at our year-over-year spot rate trends. Spot rates decreased about 2 cents a mile last week. Remember, folks, these are line haul spot rates, excluding fuel. The national average was $1.75 per mile. That's about 72 cents a mile lower than this time last year, but almost identical to 2017, 2018 levels. Having a look at our top 50 dry van lanes based on loads moved, they averaged $2.05 per mile last week. That's about 30 cents per mile higher than the national average for all lanes. In the refrigerator category, according to the USDA, reefer trucks remained in ample supply again this week. National volumes of produce are about 15% lower than this time last year. There was even a surplus of trucks reported on the southern border in Laredo and Nogales last week, even though import volumes were about 5% higher. So plenty of capacity along the southern border. Reefer spot rates generally start to increase from now until Thanksgiving, making last week's national average decrease of a penny per mile to a national average of 206, somewhat unseasonal for this time of the year. Compared to last year, reefer rates are about 84 cents per mile lower and now just 1 cent per mile higher than in 2017. And lastly, in flatbed, spot rates have dropped 14 cents a mile in the last month, down 2 cents a mile last week. The average for national flatbed spot rates, excluding fuel, was 207, just under 55 cents a mile lower than this time last year. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report. And with that, it's over to Ken for the short-term forecast.
Thank you, Dean. Much appreciated. And just to put the call out there, if anyone has any questions, feel free to drop them in the comment section below. LinkedIn apparently is having some issues, at least on my end, seeing comments. So hopefully our marketing team can see them. All right, so these are the short-term forecasts, as Dean alluded to. We've got dry van up first, just to level set folks that may be new to this chart. The blue line is the historical 7-day weighted moving averaged actual rates paid on long-haul transactions, excluding fuel. The green line extending beyond there is RateCast, our flagship forecasting model. The red line is a short-term model, which more heavily weights near-term data. And then you got a gray and a yellow, which are blends of the two. I think what you see here is very consistent. You're going to see this across all of the equipment types. You're going to see RateCast expecting things to bottom out here in the next week or so, and then starting to plod their way up for the Black Friday shipping boom. Whereas the other two are much more subdued in their nature. Let's go to dry van. I think you can see a little bit more of reefer. You can see a little bit more of a difference here. The forecasts are pretty much in consensus through the 14th or 15th. And then the red line, which again is the short-term forecast, which is going to weight more heavily the recent data, continues down into the end of the month and Thanksgiving, whereas RateCast sees a pretty considerable uptick. Last one, we're going to finish with flatbeds, and again, a very similar story. A little bit less travel between the two forecasts, but you see RateCast showing a little bit more strength heading into the Thanksgiving holiday, and the other three remaining a bit soft. So with that, we're going to go to our question of the week. Dean?
Yes, Ken, very topical subject this year around peak season and how it's been a non event for some of the carriers, especially intermodal. So question of the week is, how is peak season performing compared to prior years? With that, we've got a couple of charts that Ken's going to walk us through, and we'll fire away some questions.
Yeah, I mean, so this was a surprise. I don't want to know, like a lightning rod, if you will, on LinkedIn yesterday. We were having a conversation. I threw this chart out there, and a lot of really great questions, comments, and thoughts. And the thinking behind this first one was I was trying to show both out there on social media and into some of our own folks internally who are new to the industry, sort of the shape of peak, if you will. So when you take out like the level, like where you are in a particular freight cycle, where the freight trends are, just show me how the shape from the start of the fourth quarter to the end of the year looks. So that's really what this is. I took 15 to present. I threw out the COVID years, and I said, let's just take a look at how prices move from the start of the fourth quarter till the end of the year. And that's what this is a reflection of. And the dotted lines are the prior years sort of discretely. The red bold line is the average of those historical years. And then kind of as a little nod to the Christmas shipping season, the green line there is this year. And this chart excludes fuel. So this is just baseline. So kind of a pure expression of the market. And I think, despite all of the sort of doom and gloom and we're certainly experiencing a very soft spot market at the moment, this whole sense that peak isn't going to behave the way that it has before is, I think, a bit misplaced in that regardless of where these levels happen, and there's some noise, mainly in this chart because I'm not a statistician, I'm just an armchair analyst here. But by and large, I think anyone with any sort of chart reading ability would tell you that follows a pretty similar pattern year after year after year. It might be a little bit more extreme some years, a little bit more subdued others, but by and large, it's a very similar pattern. And this year, we're lagging behind a bit. And I think largely that I would explain that away by the 50-cent increase we've seen in fuel prices. But what do you see when you look at this, Dean?
Yeah, I guess I'm a little bit surprised that we're trending, so far below where we'd normally be. But the shape makes sense, Ken. I think it's we see that Thanksgiving bump there in both dry van and reefer. My expectation would be a little bit it'll be more pronounced in the refrigerator category, especially around that Thanksgiving bump, more so than it would be in dry van, for obvious reasons. But I think it's, I think it reflects what we would normally expect to see in the market. But I also think it reflects the softening of demand that we've been seeing. But I think your point yesterday was very valid. The impact of diesel prices can't be understated here. That's been one of the biggest drivers in, I think, spot rates in the last little while, given we were up, 50 cents a mile in 4 weeks. I know it came down yesterday slightly, but it's still a pretty big hike in the last 4 weeks now.
Yeah, so I think, too, someone pointed out what I was trying to do here was throw something together as quick as I could before I, blew off 2 or 3 meetings in the morning. But I think a more appropriate way to do this and take out some of the noise would be to average, maybe instead of jumping off from exactly day 270, maybe average days 270 to 280 and use that as the index. I think that would mute some of the volatility. But again, this isn't just a point in time. What I'm charting here is a 7-day weighted moving average just to smooth things out. So I think that helps take care of some of that. But I think at the end of the day, what you're seeing, is what we're all experiencing. And that's what I really think good analytics do, is it helps quantify and either prove or disprove what we're seeing and what we're feeling out there in the market. And with that, as a little bit of a segue, I want to go to the next chart, which includes fuel. So, we were having this debate sort of in real time, both people that are connected with me on LinkedIn and internally about, well, how can you really sort of suss out whether that impact was due to fuel or not? And so what we did was we charted, I think Kyle Lintner suggested charting the all-in as opposed to the excluding fuel. And as you can see, when you do that, it's pretty much exactly on the historical shape of peak. So what do you think, Dean?
I'm kind of fascinated by the seasonality that's exists over the last years. Even when I look at our load posts and equipment posts, the seasonality that's occurred even during the pandemic period, right, 2020, 2021, there's still seasonality that exists within those numbers, even though they were off the charts in terms of some of the peaks. I just think it's incredible to see how visually the truckload market behaves seasonally. I think that's something that we all take for granted, but don't really appreciate how it changes year to year. I thought one of the questions that was good on LinkedIn yesterday was, why was 2018 so different? I thought your answer was quite pertinent on that, because that was a great year for trucking, right? 2018.
Well, the first half of it was certainly, on average exactly. It was. It just is one of those things where, just to kind of highlight what the answer was to that question is just that the second half of the year in no way resembled the first, right? We came into the year on an absolute tear after a busy tropical season with Harvey and Irma and others, and then ELDs in December of that prior year. It took the market the better part of 6-7 months to figure itself out. Right. And then the second half of that year was very, very slow. Mm-hmm. And I think where you still saw, and I think what you're seeing with 18 is an artifact of a kind of not a very rigorous indexing methodology. I think if we put a little bit more time and effort into the indexing methodology, you'd see a tighter dispersion. But again, I think what you're seeing there is an artifact of the bottom falling out of the market in the second half of that year.
Right. And spot rates were higher than contract for, I think, right through to July in that year on RateView. And then they kind of went south in a hurry for all three equipment types. So, yes, there was a noticeable drop-off that year. 18 was really a first half phenomenon.
And even if you take 18, and again, horrible analytical approach, but if you take 18 and just nudge it up, it fits the exact shape of the red line.
Right, exactly.
And pretty much every year. Now, I think what's interesting is when we start to get into some of the kind of inner mechanics of it, like 15 was almost delayed by a week and had a sharper peak. I don't know what was happening that year, but it seems, it could have been a winter storm or something like that. But it sort of pushed it out and pushed it up. So that's more interesting to me than the absolute levels here. And frankly, I think the person who justifiably called out my statistical rigor behind creating the index said it might look prettier this way. And frankly, that's kind of the point, right? It helps me see, because if these lines were all on top of each other, I wouldn't be able to see. I'd have to probably create some Tableau visualization, and that just sounds like a headache. But so that aside, let's take this chart down because we have a few questions that have come in. And again, I apologize for LinkedIn's technical difficulties. We're trying our best to get them. We can only see comments on mobile, which seems to be a pretty global problem at the moment. But Stephen Linton, how much volatility do you believe exists with fuel issues on the East Coast, and what's its potential impact?
Yeah, good question, Stephen. I'm in the Northeast, and it's really worrying at the moment. There was an alert put out by Mansfield Oil last week on some of the supply issues. One of the articles they put out said that diesel inventories are about a third of what they would normally be this time of the year. Again, inventories generally get drawn down over summer. It's maintenance season. So seeing a dip in inventories is not unusual, but of course that's been exacerbated by the loss of production from Russia. So that's, and we've got overall fewer refineries here in the Northeast. We're a long way from the Gulf in terms of pipelines. There's only 2 pipelines, I think, that bring oil up here. So I think it's a pretty big deal. The pilot Flying J sent out an alert yesterday saying not to worry about it, but just make sure if you're buying in bulk, be aware that you might have to visit multiple refineries to fill up a load. They weren't suggesting that there was going to be any supply shortages at the retail outlets for carriers, but I think there's going to be some price impacts. I think that's your general question. I think there will be impacts on price for carriers, in particular on the East Coast, but that's going to extend to all of us here for heating oil that rely on that in the Northeast. So I think we're in for a pretty tough winter economically on the energy side. But as far as what the experts are saying, Stephen, carriers shouldn't expect any shortages that would impact the movement of freight at the moment anyway, that is.
Yeah, I mean, I think that's exactly what we're hearing. Last report I read, it was yesterday, is we have, and again, these reports get misconstrued, right? And they get picked up by press that aren't familiar with energy markets. But, we have 28 days of diesel left. It's like, that's if we stopped producing today, right? We have 20 days above current production capacity. So I agree with you completely. It's going to be a price thing. What we're hearing from a lot of shippers is there's never been this great of a dollar value disparity between the pads nationally. And there are, 5 or 6 of them, right? And so, like, if you're and if you're a shipper that's not exposed to California, or you're more heavily exposed to California, and you don't have a pad-specific fuel scale, you're essentially getting, and again, I'm going to air quote this because I don't know that I fully believe it, penalized by the fact that diesel's $1 or so more expensive in California and has been for a long time. So I think it'll be very interesting to see on the other side of this if there's any sort of systemic changes to how shippers approach their fuel programs. Because I can't imagine, especially if this is the new norm moving forward, that shippers with specific, like national shippers, I don't think they care as much. It's probably all diversified away through their different shipping operations. But if you're only shipping Chicago to Atlanta, I don't know that you care too much about the price of fuel in California. So you might want to move to a pad-specific fuel scale.
All right. Next question, Ken Alexander Escobar's got a good one for you. You've done this a few times on the show. Asks, can you please explain the mechanics of why spot rates decrease when diesel prices increase? It may sound like an elementary question, but I want to know exactly why this phenomenon happens.
Yeah, it's a great question. We've been answering it a lot lately. Sam Tibbs actually up. I owe him a response on LinkedIn because he had some data that he shared with me when I was traveling last week. So I think over the long arc of time, it doesn't, right? I mean, I just want to be very clear. Like, this all sort of evens out over a longer period of time. And it certainly, I like how Alexander mentioned this. He specified spot rates because there's a fuel scale in place. This, by and large, has relatively little to no impact. The only impact it has on contract rates is when the shipper has either a rich or a lean fuel scale. You might make some adjustments to price based on that. But let's put that on a shelf for a second. In the spot market on the short term, let's say you're paying $1,000. You're used to moving a lane for $1,000 or so, and the market's relatively kind of stable in that short period of time. And when I say short period of time, I mean a couple of weeks. Let's say you're paying $1,000 to move that load. You're paying $1,000. You might pay $1,050 or $950 or $925 or get the occasional $1,100 for it, but you're averaging about $1,000 on that lane. And let's say all of a sudden, fuel goes up 50 cents a mile. 50 cents a gallon. And that's not something we're normally dealing with, just to be clear. Like, these are normally much smaller movements. But let's just say it's 50 cents a gallon, which, very, very rough math, that's what, 5, 6, 7 cents a gallon, depending on your fuel scale, Dean? A mile?
Correct. Yep, a mile, yep.
So what you'll see, and let's just say that equates to $125 on this fictitious shipment. What you'll see is the total price to move the load won't change very much, because there's no set fuel scale. So everything's being negotiated all in. So that load that was moving on average $1,000, all of a sudden fuel goes up. the broker or the shipper on the spot market still relatively paying $1,000. They might move it up to $1,025 on average. It all depends on how it's negotiated. But if your price only went up $25, let's say hypothetically, but your cost went up $125, you're making $100 less on that shipment. So that's exactly what erodes out of your baseline haul, right? So when we talk about baseline haul here, it's essentially an inference on what you're keeping net of fuel, right? Very few carriers on the spot market are sort of creating an accounting ledger table with fuel and base, right? They're essentially, we're using base as sort of our guidepost for what is retained after you pay for your single largest sort of variable expense, which is fuel. So in that instance, fuel went up. Your price you're able to charge your broker or your shipper didn't necessarily go up as much, if at all, right? Which is kind of where we're at right now. So therefore, you put less in your pocket because you put more in the pump. That's the most practical. Did I cover that well enough, Dean?
Yep, excellent.
Now, over the long arc of time, things do normalize, right? Because increased cost pressures may cause capacity to shift into leased operations or out of the market altogether. Capacity becomes more scarce. That puts upward pressure on rates. Carriers are allowed to kind of negotiate for the fuel that they weren't making, and then it sort of all evens out over a longer arc of time. But in the short term, I can point to pretty much any example where fuel has went up more than 3 or 5% in a week-over-week basis, and you will see a resulting dip in the baseline haul for a 2 to 3 week period. Right. It's pretty much as predictable as trains in Japan, right?
Yep. All right.
One more?
Last question. Yeah, last question from Nick Patel. Good question. And we don't have Professor Jason Miller on until the 20th of December. He would know the answer to this off the top of his head. I certainly don't. Maybe Ken does. Do spot rates have any correlation with the Purchasing Managers Index?
Sure. I just don't think on as short of a time as people would love to find convenient. Right. I mean, the single biggest determining factor. So think about the spot rate for freight as a stock price. Right. So Apple's a horrible example. Let me find a better one. Caterpillar's long-term stock potential, if you're a long-term investor, is going to be based on big macroeconomic variables, right? Industrial production, consumption, mining activity, farming activity, civic construction projects, all of the things that you might track to help guide your decision to invest in Caterpillar long-term, right? So that's kind of like the contract rate market in freight. If I'm a day trader, right, think of that as the spot market. The most heavily sort of dependent thing are these sort of intermediate micro variables that are driving the spot market. So it might be tender rejection, or the opposite of that would be like routing guide compliance is what we would call it, right? So less freight making it to the spot market for an equivalent number of trucks will necessarily drive prices down because you have more capacity and less freight. More freight than you have new capacity available will necessarily drive rates up. And those underlying components of demand and supply, shipments and trucks, will respond rapidly to those changes. And that's why you'll see sort of more volatility, more noise, but also more rapid response. Right. On the contract side, you're subject to rebidding cycles. You're subject to large fleets investing in retail or OEM capacity, whether that's from auction or new. So they respond much slower to those pricing signals, which is why you see contract lag, right? So that's really the proxy. Yes, PMI is driving spot rates the same way that it's driving contract rates over this longer sort of window. But in the short term, if PMI goes down 1 month, or LMI, or any of these things go down 1 month, it's not like you're going to see like this reaction in spot rates immediately. So they're very much related. I wouldn't know that on the short-term basis, they're very tightly correlated. I would use, if I was building a model to forecast contract rates, wink, wink, I would probably have LMI, PMI, PPI, industrial production as variables into that model. Short-term, though, spot rates, I don't know that I would care too much about it.
Okay, shout-outs, Ken. To wrap up the show, Sales Chatter again on tomorrow with Dan Deegan, 9 a.m. Eastern. You can connect with them on LinkedIn. I'll be back on Landline now at 7 p.m. Eastern tomorrow night on Road Dog Radio, channel 146 on Sirius XM. This weekend, if you're in Houston, I'll be speaking at Freight Fest. And don't forget to download our weekly market update, dat.com/market update, or for subscribers on our new IQ dashboard at iq.dat.com. And with that, it's back to Ken to wrap up the show.
Yeah, so we're going to have some interesting guests coming up to the end of the year. We usually do our end-of-year wrap-ups, so be on the lookout for some of the fun guests we're going to have coming down the end of the year. From everything I heard, TIA was a great success last week. We had representation there. I heard nothing but really, really great things. I heard there was great weather down in Phoenix, which is not really hard to predict this time of year. But I do want to thank everyone for joining, and I apologize we couldn't be as active as we wanted in the comments. I will figure out who to complain to at LinkedIn about that. And I think that's all I have. We'll see you next Tuesday at 10 a.m. And I hope everyone has a great week. And remember to set those clocks back next weekend or this weekend. Talk to you later. Bye.
Bye-bye.